Ladies and gentlemen, good day and welcome to the NIIT Limited Q4 and FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vijay Thadani, Managing Director and Vice Chairman of NIIT Limited. Thank you, and over to you, sir.
Thank you. Good afternoon to all of you. Also, good morning or good evening in case you're joining from international locations. First of all, thank you very much for joining this call today, and your presence here means a lot to us because you decided to give time to guide us and give us feedback. This call is to discuss the business performance for Q4 as well as the full financial year ending March 31st, 2022 of NIIT Limited. I'm requesting Sapnesh to first provide an update, and that before he does that, I would also like to just set the context. So first of all, I would like to inform that the financial year ending March 31st, 2022 has indeed been a milestone year for NIIT. There have been a number of important milestones crossed. First, NIIT completed 40 years of operations, and in these 40 years has touched nearly 40 million people. The second, one of the better years in terms of financial performance, as well as in terms of customer addition, inorganic expansion, partner addition, new business models, peer recognition, and of course, ending the year with the beginning of the reorganization journey that we embarked on. The strong results that we'll share with you are in terms of revenue growth and profitability, and they are also a testimony to NIIT's resilience, sustainability, ability to transform to remain relevant, and the brand trust that we have built in the markets that we service over the last 4 decades. The results also reflect the sharp transformation that we have achieved over the last couple of years, defined and driven by the agile and decisive actions, the depth and breadth of our experience in learning technologies, and the strong execution capability that the company has displayed. So we started the year by investing in the growth agenda and in talent, which has become the top priority for every corporation. But to describe to you the journey of the year as well as where we stand right now in terms of our readiness for the future, I would now request Sapnesh Lalla, CEO and Executive Director, to share the initial brief. I may also mention that we are joined here in today's call by our Chairman, Mr. Rajendra Singh Pawar, and my other colleagues, Mr. P. Rajendran, the Joint Managing Director and Executive Director, Mr. Sapnesh Lalla, the CFO, Mr. Kapil Saurabh, who looks after Investor Relations and M&A, and Mr. Uday Singh, the Chief Strategy Officer, as well as Mr. Deepak Bansal, who's the Company Secretary. And we would all be very happy to entertain questions as well as answer them to the best of our abilities at the end of the initial brief. So with that, over to Sapnesh.
Thanks, Vijay, and thanks everyone for joining this call. Please note that based on the proposed reorganization of the company, the residual schools business, which was earlier classified as an asset held for sale, is now classified as a business with continuing operations. And therefore, the financials have been consolidated in the current as well as previous quarters for like-to-like comparison. With that out of the way, let me start to give you the overall highlights for both Q4 as well as the financial year 22. In Q4, NIIT's revenue stood at 3,750 million INR, and it was up 35% year-on-year. Both the corporate learning group as well as the SNC businesses have achieved robust growth on a year-on-year basis ahead of our expectations. I will cover this in more detail later on in my presentation. The revenue was down 3% on a quarter-on-quarter basis, given that Q4 is a traditionally low quarter for NIIT, both for CLG as well as SNC. Excluding the RPS acquisition, which was consummated on 1st of October of 21, the revenue was 3,460 million, and organically, the business was up 24% YOY. The EBITDA was at 372 million, up 6% year-on-year. The tax was negative 14 million for the quarter. This includes a net tax benefit of approximately 180 million arising on the planned completion of voluntary liquidation of NYJL during the quarter. The profit after tax was at 674 million, resulting in an EPS of rupees 5 versus rupees 3.30 last year. The EPS is up 53% year-on-year. Overall, for the fiscal year 22, the revenue was at rupees 13,775 million, and that was up 44% year-on-year. Excluding the RPS acquisition, the revenue was 13,183 million, and that was up 24% year-on-year on an organic basis. The EBITDA was rupees increased these investments. About 3.5, 4 years ago, we started investing significantly in the life sciences segment from a sales and marketing perspective, and that segment now is approximately 15% of our business. Earlier this year, we started investing in the higher education segment, and we expect that segment to start contributing materially from FY24 onwards. So we continuously have a track record of investing ahead of time in sales and marketing so that we can accelerate growth. In SNC as well, we have been investing disproportionately in sales and marketing, and you've seen some impact of that in the profitability in SNC. But I think from an overall perspective, that's part of the strategy to establish NIIT as the first choice, not just for our enterprise customers globally, but for our skills and career customers in India as well.
So when you said 20% growth and 20% profit trajectory, should you reckon that from this year, FY23? Because if our margins sustain even at 24% in this segment, I'm not sure how the numbers will add up at a bottom line level. I'm just alluding to your guidance of 20% profit growth in CLG.
Yeah, like I pointed out, we are investing significantly for entry and expansion in the higher education segment. We've already had traction with 2 large public universities, and obviously to stand up a go-to-market team costs a fair bit of money, and that's really the difference. To some extent, the difference is also because of the inflation in overall costs, predominantly people costs, as well as the opening up in terms of premises costs as well as travel related expenses in the upcoming. In FY23.
We will still be in a position to end 23 at 20% higher than last year in earnings. Is that what you meant? Did I get you right then?
No, I think I said that we would be able to end the year with 20% growth at 20% margin.
20% margin. All right. Thank you very much, and my best wishes.
I think, Vaidik, one more thing which I would like to point out is I think both the businesses have a certain degree of seasonality across quarters. So you should not read 20% to mean 20% across the year, because last 2 years have not been typical years, and in the coming year, once more time, while we believe that end of the year the growth will be exactly we are aiming for 20% growth and 20% EBITDA. The profile that it will follow across quarters may vary, and the second is also growth year-over-year versus last 4 quarters may also vary, given the peculiarities of last year as well as the seasonality, which is very relevant in the coming years. So you would like to check the past track record of our quarterly performances, you would be able to correlate with that.
I would also say that there is significant environmental uncertainty, and as the situation changes, if we see any changes, we'll of course come back to you.
Thank you. The next question is from the line of Siddharth Basi, an individual investor. Please go ahead. Siddharth, your line has been unmuted. Please go ahead with your question.
Hi. Firstly, thank you for the opportunity. Congratulations on the great numbers. I've been a long-term investor in NIIT, and it has made substantial wealth for me. So thank you for that. Just going on to the future, when you're talking about growing the SNC business and disproportionate investments, could you give us more data on the same? Like, what do you mean by exactly by disproportionate investments in terms of quantum? Secondly, with respect to the demerger, or rather with respect to the companies becoming two, there will be significant, I'm assuming, real estate assets as well. Could you give us the valuation of the same? And secondly, while taking this decision, the board would have come across certain numbers in terms of valuations of either companies on a standalone basis, which would obviously be greater than the valuation of NIIT right now as it stands. So would you be in a position to share the sum of the parts valuation so that there's less information asymmetry in the market, because different individuals seem to have different numbers for the same? And thirdly, in a market in the US which is talking about recession, how do you see training as a skill set being prioritized, where NIIT will then have an opportunity to grow and maintain margins? Thank you so much.
Siddharth, first of all, thank you very much for your very kind words in the beginning. I think it's a great source of encouragement for the team. Second, I have to compliment you on very deep understanding of our businesses. So indeed, you have been studying this company for long. I'll request Sapnesh to answer some of these questions for you. And if there is any left, then I'll chip in.
Sure. I think I'll try to start with your third question first. And that was, I think, around how do I see recession playing out as far as our corporate business or the business overall is concerned. I think from an overall perspective, in the medium term, every recession has resulted into increased propensity to outsource. And that is really a result of most organizations trying to focus on what is core to them and then work with specialists to do what they may, what might not be core to them. For most of our enterprise customers and prospective customers, training is not a core business that they are in. Our customers tend to be in the technology space, in the telecom space, in the banking space, financial services, insurance, energy. For all of these organizations, training is not core to their business. They do it because they are good at it. They've done it all along. But they also feel that they are a reliable source for training their own people. As our customers would testify, our customers find in NIIT a reliable organization who they can trust to deliver as well as themselves, if not better, on their training needs. And I think as the propensity of corporations increases in terms of outsourcing, as they start focusing more and more on their core services, NIIT will have an increasing right to win, given how well we have done with our existing customers. So that's really my take on recession. Now, in the short term, we might see headwinds as organizations look at optimizing their spends overall. But in the long term, across the last 2 or 3 recessions that I've had to participate in or I've experienced, we've seen an increased propensity to outsource. I think you had a couple of other questions. I think one of your questions was how would we value the 2 organizations separately? I think that's really for your community to decide rather than for me to put a price on the organization. I think it's going to be in the eye of the beholder. What I think we will continue to execute on is to do our best to create value for our customers and to have as much growth, as much profit, and do all of that to the highest standards in terms of ethics. That's what we will guarantee. And I think if we do that for our customers, growth will come, and our customers and our shareholders will value us for that. So that's really my take on it. I'm not the one to value. I think it's going to be in the eye of the beholder.
But I'm sure when you're doing this process of splitting the company into 2, there's an SOTP, I'm sure, that comes at your desk. And since, individual investors often don't get to know as much data as institutions or larger investors. So just in the interest of fairness, if it's possible, that if such numbers have come across to you, if you could share those. And secondly, in terms of other assets that the company may own, how would you value those, and are we valuing them at this point of time, and which company are we putting them in?
Okay, so let me try to mention this. First of all, there is no information asymmetry between what a large institution knows and you know. Everybody has the same information. By law, we are mandated, and as a practice, we have done so from day one. So, whatever data that is available, and we do not like to create a speculative practice and speculation around what the price might be. It will be very, very unfair. I think our job is to ensure that we create value for our customers. Our actions result in their paying us, and that creates value for our shareholders. How the shareholders value that is visible in the way. Now, for comparison's sake, typically the CLG business gets valued versus the outsourcing services outsourcing companies like IT outsourcing companies. And given the unique position we are in, typically we believe statistically that we get valued at a premium to our equal sized companies, the same size companies. That's just experience, and that's nothing. I'm not adding data to that. As far as the skills and careers business is concerned, they get valued more like the companies of similar nature which are there. Not too many of them are listed, but from private valuations and whatever other methods that we figure that are there, that you could think of comparative valuation. But please take that as my guidance. We are not here to guide you on how the valuations will be. What we can tell you is what the company's strategy will be in terms of the business. The third element of the question that you had was assets that the company has. Both businesses have their assets clearly marked out because many of them are in different geographies, and even the soft or the hard assets are clearly marked. Having said that, there are common soft assets, and both entities will have access to those soft assets. In terms of real estate, the company has been an asset light and does not have a lot of real estate. But the real estate, whatever there exists at this point of time in this part of the world, would remain with NIIT Limited. Have I answered? That's what is mentioned in the scheme of arrangement, and that is shared with everyone.
Absolutely. Thank you so much, sir, for the opportunity. I must say NIIT's management has always been transparent and great. And I've had a great journey with this company for the last 4 years. If I may mention, the stock price is ever since the 70s levels, and I hope to see it to go to 10,000, and I'll be great and still be riding on it. Just a shout out to Mr. Kapil Saurabh as well. Yesterday I had issues in terms of being able to get to the call, and he was very prompt in resolving my issues. Thank you so much, and thank you so much for all your answers, and keep up the good work. Thank you so much.
Your comments mean a lot to us. Thank you very much. Thank you. Let's open it for next question, please, operator.
Thank you. The next question is from the line of Preeti Panchal, an individual investor. Please go ahead.
Thanks for the opportunity. My question is regarding employee benefit expenses. In the Q4, the employee benefit expenses has reduced, whereas in the presentation it is mentioned that the employees numbers are increasing. So I just wanted to understand the contradiction between these two.
Employee benefit expenses. Have you read those from the published? Are you reading standalone results or are you reading consolidated?
Both. It's a reducing in both.
Okay, we'll just handle the question because typically we have a summary sheet in front of us, but we'll get you an answer to that question.
No problem. Thank you.
Thank you.
Thank you. The next question is from the line of Harshil Sethia from AUM Fund Advisors. Please go ahead.
Hi, sir. I want to clarify on the previous participant's question. When you said that revenue guidance of 20% and EBITDA with a margin of 20%.
Sorry. I'm so sorry to interrupt you, Harshil. I would just request you to move your mouthpiece slightly away from you. There's a static from your line.
Okay.
Please confirm.
Hello?
Yes. Please go ahead now.
Yeah.
Yeah, if you can just move the mouthpiece a bit away from yourself.
Yeah, it's done. Am I audible?
Yes, this is better. Please go ahead. Thank you.
Yeah. Hi, sir. When you earlier guided with a revenue guidance of 20% and EBITDA margin guidance of 20%, so does that mean that going ahead that there will be an EBITDA degrowth going into FY23 for the CLG business?
Like I pointed out, the EBITDA we are guiding at about 20%, predominantly on account of the following. Number one, additional investments in sales and marketing. And second, we are also going to see or we are anticipating travel and premises costs to resume. And that's the reason for the guidance.
Okay. And that is just for the CLG business, not the company as a whole, correct?
That's correct.
Okay. So, which means that your EBITDA on an approximate estimate would be around 270 crores for the next year, assuming that skills and careers business remains flat at 0%.
Give or take, yes.
That's the math.
That is the math.
Just take the numbers we just gave you. That's the math.
Okay. And sir, the second question.
Just add any exchange variations to that.
Exchange variations, and then again, like I pointed out earlier, we are in an uncertain environment at this point in time, and in case we see any uncertainties in our business, we will come back to you.
Okay, so your 300 crore, approx 299 crore EBITDA will be 270 crores going ahead for the next year. And sir, I had a second question. Earlier we were of the view that we were hiving off the schools business. So what changed that now we are clubbing it with the CLG business?
I think from an overall perspective, that business is less than 0.5% of our overall business, and from a materiality perspective, it is insignificant. We pointed out earlier, the CLG business is being merged into that entity.
Okay. So, are we planning to add further resources in the schools business?
So, like I pointed out earlier, we stopped taking on new contracts. We have some existing contracts which we are servicing as promised to our customers, and we will continue to service those contracts till those contracts stay in force.
Okay, thank you.
Thank you. The next question is from the line of Srinath M. from Motilal Oswal. Please go ahead.
Yeah, good evening, everyone. I had just one or two questions. If I read the exchange release right, dividend was one of the agenda of today's board meeting, but there is no mention of final dividend or any such thing. Any clarification on that?
Yeah. So I'll respond. If you were there in last board meeting or last call, then I would like to remind that in Q3 the company had given an interim dividend.
Sure.
And that was given in line along with the statement, which is in the transcript also, saying that given that the company will be in the next 12 months in the period of restructuring or reorganization and the scheme of arrangement is in force, the board felt that it will be prudent to consider any dividend only after completion of the scheme of arrangement. Otherwise, there will be technical difficulties in figuring out how to split that between the two companies.
Right. And related question is...
We had guided that the next dividend would therefore be considered at the end of the scheme of arrangement. And by the two companies, each individually. And that will be the more prudent thing to do. And to that extent, therefore, there was no announcement of dividend this time.
Right. And related question is on the cash balances, which is actually deflating our return ratios. I mean, the two go hand in hand actually. Payout would have actually reduced the cash balances and improved our return ratios. And also, the second point is, I remember having read that the cash is going to be equally divided between the two. You spoke of other assets, but the cash, which is at around, I think, 1,200 crores, is going to be equally divided between the two companies. Is that reading right?
No, your reading is wrong. We had actually shared that about 500 crores would be given to the NIIT Learning Services Limited, and the balance would be with NIIT Limited, would remain with NIIT Limited. And we had also explained the rationale that the NIIT Learning Services Limited, which is the CLG business, is a cash-generating business. And at this point of time, this would be sufficient to look after their growth ambitions as well as the needs that they have from time to time. On the other hand, NIIT Limited is in an investment cycle right now, and therefore would need the cash in the short and medium term before it starts generating enough cash to look after its own ambitions.
Right. Okay. Thank you.
So that is as far as the cash thing was, the cash division was concerned. I would also like to comment that while the return ratios in short term may appear the way they are, and you are right, but I think given the uncertainty in the environment and a very specific inorganic growth plan that the company is embarked on, of which one action happened in the second part of last year, I think this cash in the kitty will create a state of readiness for both businesses to look at appropriate opportunities and take advantage of them. So we believe that at this point of time, having cash in the balance sheet is actually a very strong positive for the company. I must also mention that many of our customers look at the financial stability of the company in these uncertain and volatile times before they would consider us for the award of the contract, including one very recent one, which we got 2 quarters ago, where I think the financial due diligence was to look at the financial stability, and they were greatly comforted by the fact that we had sufficient cash to handle any ups and downs in the environment.
Right. Thanks for the response.
Yeah.
Thank you. The next question is from the line of Sahil Sharma, an individual investor. Please go ahead.
Hi, sir. Congrats for a good set of numbers. I want to understand. After you understand it as outside investor.
Sorry to interrupt you, Mr. Sharma. Your voice is breaking up. We cannot hear you clearly. Request you to move to a better reception area, if possible.
Can you hear me now?
At the moment, yes, we can. You may proceed.
Sir, I was asking that in the SNC business, as far as we understand it as outside investors, this is a very sort of crowded or with a high competitive intensity kind of space right now. With a lot of competition from PE-funded startups as well. So what I wanted to understand is that on the SNC side, like what is the strategy for NIIT that differentiates our offering to our customers?
I'll ask Sapnesh to answer that.
Thanks, and thanks for a very good question. I think the most fundamental thing that differentiates us is the same that has differentiated us over the last 40 years. It is our ability to use technology, learning pedagogy and learning design to ensure that the learning outcomes that our students aspire for are actually created. And that is really why NIIT's brand holds the trust of its students. While I would agree that the market is crowded, there are many organizations who offer all types of training programs. But I think what we are proud about is our ability to deliver the outcomes that corporations and employers very specifically value. And that is seen by the testament that the students who graduate from NIIT are often able to get jobs that pay twice as much as the students who got jobs directly placed from campus. So it's that brand trust that we have earned over the last 40 years, which is driven by the pedagogy, the technology, the design that we use that ensures that the outcomes that we promise in our training programs actually get delivered, and the students who graduate have the skills to be able to perform the day they start working.
Okay, thank you for that. Also wanted to understand in terms of the CLG business, you have mentioned in one of the previous conference calls that we have like a 30% deal win rate. And in a separate conference call, you have also mentioned that actually, our capture of the market share has accelerated in the COVID period. So what I'm trying to understand is that what is the rationale behind the higher sales and marketing spend in the subsequent quarters, given that we are already doing very well in terms of, capturing the deals and gaining market share?
I think that's an excellent question. I think I've pointed out often on these calls that the learning outsourcing market is a significantly under-penetrated market. At this point in time, fewer than 25% of the companies in the Fortune 1000 outsource appreciably. And so we have very significant headroom. And I think given the fact that we are doing better than competition, it is only upon us to invest and ensure that we create distance between NIIT and competition and gain higher market share in the shortest period of time. And that's really the reason for disproportionate investment in sales and marketing, as well as creation of new and expanded capabilities.
Okay, thank you so much.
Thank you. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Hello. Hello.
Yes, sir. Please go ahead with your question.
Thank you very much, sir, for the opportunity. So I wanted to understand specifically on SNC segment. Now we did speak. I think we are looking revenue to grow about 50% and maybe a small break even of profit this year, FY23. So I just wanted to understand next 3 to 4 years how you see the trajectory for SNC group, SNC segment EBITDA margin. Yeah.
I think over time we expect high teens to almost 20% margin. We've guided that this business has the opportunity to grow 5x over the next 5 years. And as the business accelerates and reaches a critical mass, we expect the margins to go into high teens and over time into the 20% range.
High teens. And next 1 to 2 years, now I think in the fourth quarter we were at about 2% EBITDA margin, right? So ideally one should envisage that this margin percentage should keep on increasing in next 1 to 2 years as well.
No, I think what I've said is that we expect to either be just about break even on the EBITDA margin for the SNC business. Like Vijay also pointed out, that's a business that's in an investment cycle at this point in time.
Correct.
And we expect that the margins will be just about break even or thereabouts.
Understood. And understood on this one. And my second query is on your demerger. Now, sir, I just wanted to understand that in terms of demerger, is there any cost angle that there were some synergies that we were getting on this combined entity, and because of the demerger, that synergy will go away, or it will add some duplication of that some cost. So, any kind of comment on those lines would be helpful.
I think, and I think you may have heard this when the scheme was announced as well. The two businesses are significantly separate, but they are joined by our culture and our ethos and our brand. As we separate the two businesses, we will have some additional costs with respect to overheads in terms of HR or finance and so on and so forth. But outside of that, the business-related expenses are significantly separate.
And I think most of the synergies that, or the common resources that Sapnesh said, are more of the soft nature. And I think there the management teams which will go to each side will carry that tradition and culture forward. So what we see is a significant upside versus the small cost that may be there in short term.
I understand.
The independence, decision-making, agile decision-making and investment capability will create significantly more value for our customers as compared to the marginal increase in cost.
Fair enough. Yeah, that's great. That's all from my side. All the very best, sir. Thank you.
Thank you. Operator, I did want to have Mr. Sanjay Mal, the CFO, to answer the lady's question on employee benefits. So just Sanjay, just explain.
Hi. So there is a question that, in quarter 3, this Q4 versus previous quarter, there has been a decrease in employee benefit expenses. This is around 22 million, as you would see from the results. This is primarily on true-up of provisioning in relation to actuarial valuations on leave and leave benefits and gratuity benefits. As we all know that the interest rates have basically gone up and the discount rates are accordingly factored, which leads to basically a lower provisioning in this quarter. Of course, there has been a net addition which has also had the impact of net addition of people, which has had the impact of higher costs. So the net impact basically is about 22 million after throwing up of the provisions on account of provisions in leave, gratuity and related expenses, and the addition into the number of people.
This is an annual cycle.
This
happens every year.
Yeah, so this true up is done every year
Yeah.
at this point of time, and that's what has happened.
Thank you.
On. Is there a last question that we should? There are 5 people waiting for questions. So, operator, can we stop at these 5 questions because we already well past the time? But definitely we would like to answer each one of them. So if they can answer one question each, please.
Thank you. We would request participants to limit your question to one at a time. The next question is from the line of Ashish Kacholia from Lucky Investment Managers. Please go ahead.
Good evening to the team and congratulations on a good set of numbers. My question pertains to the opportunity size for the SNC business that you mentioned. Did I hear correctly that you said it's a $15 billion opportunity?
That's true. It's a $15 to $20 billion opportunity.
And any thoughts that you can share on the logic of this $15 to $20 billion?
Yeah, I mean, I'll start with the fact that there are 5 million people who work in the IT industry, and every year the IT industry adds an additional. This year they've added an additional 450,000. Other years they've added about 250, sometimes 300,000 people. But that's just the IT industry. From an overall perspective, India graduates about 6 million or 6.5 million students each year. From an early career perspective, if you look at 2 years, and assuming that only about 10 to 15% of those graduates get jobs straight out of campus, just in the early career segment, we have an opportunity to educate approximately 5.5 million people and help them get the aspirational jobs that they are looking for. If you go beyond that to people who are working adults, like I pointed out, about 5 million people work just in the IT industry, approximately 1.5 to 2 million people work in the banking industry, and then significantly higher numbers in India enterprises. Given all of that, I think we have a very strong opportunity ahead of us, given the routes that digital transformation has already taken and the acceleration of digital transformation, not just with GSIs and GCCs, but spreading across Indian enterprises as well. I was at a meeting about 3 weeks ago with among the largest search companies. I'll just not name the company. And from their point of view, they said that digital literacy is going to be equal to literacy in citizen programming, literacy in data, and literacy in cybersecurity. So, if you look ahead, every person who's a working adult will have to be literate about digital technologies, and I think that will only accelerate the opportunity set that I just described.
And of this $15 to $20 billion, how much do we think we are already kind of addressing as a market or as a capabilities? And going forward, how do you see that?
I think we have, what I would say is, I am pretty close to the numbers that we have generated. I'm sure you are as well. And I think the headroom is phenomenal.
No, I was just saying, out of the $16 billion, what percentage of this market can we target with our capabilities as of today?
I think we can, like I pointed out, there are 5 million people who work in the IT industry. There are about 300 to 450,000 people who join the IT industry each year. So if we, and while a capability set is beyond that, even if we were to limit ourselves to that capability set, it's a significant percentage of that 15 billion.
Thank you very much. All the very best. Bye.
Thanks, Ashish.
Thank you.
Your comments mean a lot to us, and so does your questions.
Thank you. The next question is from the line of Shraddha Agarwal from Asian Market Securities. Please go ahead.
Yeah, hi. Congratulations on a good quarter. So just one clarification on the skills and career business segment. You said that you expect the profitability to be just break even or thereabouts. So does that mean organic SNC or for the overall SNC business including RPS? Because if I'm not mistaken, RPS was operating at a good double-digit margin. And if you consolidate RPS for the full year, we should be ideally looking at single-digit margin, if not more, for the overall SNC business in next year.
Yeah, it is for the consolidated, and it really represents the investments we are going to make in the growth of the SNC business. Like guided, we are hoping to be on a trajectory that gets this business to 5x of what it is today in the next 5 years.
That's true, sir. That was always the aspiration that we would want to take this business 5x of the present size. But I think the directional sense on margins was that margins should ideally look up each quarter. And from the 2% exit margin that we are at, we are talking of margins going down further in full year 23. So how should we read about the profitability trend of SNC going ahead? Because this is a good deviation from our earlier stance of margins being trending up rather than going down in this business segment.
I think at least in the conversations I've had, and I know of the conversations we as a team have had, we've always felt that for the SNC business, it's very important to be at a fast growth path and be able to ensure that we become the first choice in the first couple of years and then start looking at margin expansion.
Right. And also on the corporate learning segment, where are we in terms of split of physical and virtual training currently? And are our clients pressing upon us to go in for more in-person training than virtual training before?
Yeah, in Q4 we started to see the beginnings of in-person classes, and I think that is only likely to accelerate.
Any number can you give as to what is the split between virtual and in-person now versus what it was 2 quarters back?
It's still small as a number, but as things become more normal, this number is likely to grow quite significantly. It is likely to come to not exactly the pre-pandemic levels, but maybe just short of that.
And so one last.
But certainly not 100%.
Right. So, and just on the CLG business again, I mean, last time we had indicated that we want this business to be 3x of the run rate, like from $150 million, we can expect this business to go to $450 to $500 million in the next 5 years, implying a CAGR of almost 25-26%. And now we are guiding to a 20% growth in this year. So are we building in some conservatism in our guidance for next year, or how should we look at the medium-term aspiration versus the immediate guidance that we have given out for this segment?
Yeah, I think we are preparing ourselves to achieve the 3x that we mentioned, and we know what it would take for us to get there. I think we are taking one step at a time, and I'm also cognizant of the environment that you see in the market today. So given all of that, I think our guidance of 20 would make sense.
Right. Yeah, that's it from my end. Thank you.
Thank you. The next question is from the line of Nirmal Bari from Samiksha Capital. Please go ahead.
Yeah, so thanks for the opportunity. My first question is...
Sorry, Mr. Bari, your audio is not very clear. Can you please move your mouthpiece slightly away from yourself and then ask your question?
Is this better?